Hello and welcome everyone to the AIM Summit weekly webinar. I'm your host, Zachary Seferati, CEO and founder of Invictus Capital. This session is on building blocks. Can the DeFi revolution be the first step in the new global financial system? I'm happy to be the strategic partner of AIM Summit. We have over 35 countries participating in this session today. Thank you for dialing in from all over the world. Amongst you are institutional investors, family offices, high net worth individuals, and many leaders of the financial services industry. Please feel free to submit your questions as they come through at any time throughout the session. There's a Zoom Q&A dialogue at the bottom of your screen. Feel free to submit them as they come. We'll address as many questions as we can towards the end of the session. If you're joining us on YouTube after the fact, be sure to like this video. Please subscribe to our YouTube channel and be sure to go to aimsummit.com to subscribe to receive the live sessions where you can directly participate with our resources in the Q&A. I'm so happy to be introducing our webinar partner today, Invictus Capital. Founded in 2017, Invictus Capital is grounded in the idea that investment should be democratized, accessible to everyone, more affordable and transparent. Using blockchain technology and a data-driven approach to radically transform the investment industry, Invictus Capital allows investors to have a diversified portfolio and reach ambitious investment objectives. I'm also introducing from Invictus our moderator today, Daniel Schwarzkopf, who will be leading the fireside chat with our guest, Joe Lubin. Daniel Schwarzkopf is a South African business executive with a firm startup experience and a proven background in the technology and social networking sectors. He's the founder of BetVIP, the world's first licensed Bitcoin-only sportsbook and casino, and has been featured in everything from Business Day to the Wall Street Journal. He previously founded FSMS, a VC-funded telecom startup with more than 400,000 registered users, where he first found passion for using machine learning to discover rich interactions and extract value from massive data sets. Daniel's going to be moderating our session with none other than Joseph Lubin. Joseph Lubin is the co-founder of Ethereum and the founder and CEO of ConsenSys, one of the world's leading blockchain technology companies. In 2014, Joseph co-founded the Ethereum project and founded ConsenSys to focus on building infrastructure, developer tools, and decentralized applications through the Ethereum platform. Prior to working on Ethereum, Lubin's career was focused on the intersection of cryptography, engineering, and finance, including his role as VP of Technology and Private Wealth Management at Goldman Sachs. Joseph graduated cum laude with a degree in electrical engineering and computer science from Princeton. Again, thank you both so much. We've been so excited to have this session. Over to you, Daniel, to moderate the fireside chat. After that, we'll be taking Q&As from the audience.
Great. Hi, Joseph. Welcome. Yes, to start out, I think a great thing would be to introduce the audience essentially to what DeFi is. I think that's something that a lot of people might be familiar with, more in the crypto space, but many of those involved in traditional finance would have no experience with the term. What would your definition of DeFi be?
So first, it's important to recognize that increasingly we have a trust problem on the planet, and more people are becoming aware of it. With blockchain technology, we have an opportunity to replace the subjective trust infrastructures that are in place with automated and objective trust systems. Decentralized protocols have the potential to be a new trust foundation for the planet, and that new trust foundation, because they're decentralized and because they're enormously expensive to improperly manipulate, the new trust foundation can enable what we like to call a global digital asset settlement layer for the planet. Decentralized finance represents a potentially new financial plumbing layer for the planet. It represents different kinds of protocols that are built to subserve things like lending, borrowing, issuance of securities like equities and bonds, issuance of derivatives, constructs like insurance and prediction markets and automated portfolio management. The exciting thing about all of these is that they're being built in a democratized way. Lots of experiments are being run, and many of those experiments are attracting billions of dollars worth of value to these new financial instruments. And these new financial instruments are essentially in the form of digital, modular, composable Lego blocks, so that it is relatively easy to wire these different elements together into increasingly sophisticated structures. So this new decentralized finance ecosystem is still very immature, but it's pulling in certainly the best and the brightest crypto nerds, but also the best and the brightest financial nerds. And so I expect that the experimentation will continue, and we'll figure out how to mature these systems and make these systems relevant to companies that can benefit from these new mechanisms.
Great. And so as a follow-up question to that, are people not essentially transferring the sort of decentralized, the counterparty risk, are they not just transferring that to a technological risk by utilizing DeFi? And by that I'm referring to, the multitudes of hundreds of millions of dollars that have been hacked or lost or stolen in the past couple of months. Things are moving very quickly. I do understand that, DeFi as a whole is something that is evolving at an extremely rapid pace, even day to day almost, with some new projects spinning up billions of dollars of total value locked almost overnight. And so it's not impossible to foresee that there would be some technological consequences to that. Vulnerabilities popping up. How do you see that changing as we move into the future?
Yeah, so I would say that essentially your thesis is correct. That first of all, there have been large amounts of money stolen in the context of blockchain systems and crypto assets. Most of the time that happens at the exchanges, sort of at the boundaries between the legacy financial systems and the new decentralized protocol-based financial systems. And generally the blockchain-based systems have been rock solid at the deeper protocol levels. Certainly there have been issues with some of the protocols built on top of these systems, and we would expect that you can't build a perfect system right away. You need to build and iterate, and generally there are people who will help show you where you've gone wrong in your design, and they'll extract their consulting fee for that. Your thesis about trading counterparty risk for technological risk is a good one, and I think it's a good trade-off. So early on in the building of the systems, when the technology is still a little bit immature, you may think that that's a bad trade-off, but as we keep iterating on these systems, we build better and better systems, and the better and better systems are built out in the open. So with the use of open source, thousands of eyes on a code base, constantly improving that code base, we can squeeze out the weaknesses of the protocols, reducing the technology risk, whereas there's certainly technology and rule systems that can try to squeeze out counterparty risk, but ultimately at the end of the day, there is a counterparty in those situations that can fail. That's not necessarily the case, and often not the case in these decentralized protocol systems where transactions can be trusted, even though you might not know who you're interacting with, or certainly won't trust who you're interacting with, and execution can be guaranteed by these mechanisms.
I see. And in terms of some of the major projects popping up right now, to say some of the ones that have recently risen to prominence, Uniswap's been one that's been around for quite some time actually, and I've had people building on it consistently. What are your thoughts on the issues that kind of plague decentralized exchanges today, particularly, you know, the role of automated market makers? What are the key sort of things that could be improved there, particularly in terms of, you know, large transactions that can be front run, and, you know, the natural nature of toxic order flow that automated market makers have to face just by existing, as, you know, primarily they achieve their pricing via arbitrage. Is there some way to mitigate that? Is there some way of, you know, building an order book, say something like IDEX, where people would interact on a secondary layer? Obviously that necessitates people having to deposit currencies and so on. But primarily I see that, you know, the explosion in liquidity that's come to DeFi has been, in my opinion, primarily due to, you know, the financial incentives that people think they can achieve by providing X or Y liquidity, you know, in terms of yield farming. I mean, we can give a quick explanation of what yield farming is. Essentially, people provide liquidity to automated market makers, and, you know, in return, they receive X or Y token that's involved in the ecosystem in some way. Do you see that as a sustainable model?
Yeah, so I think you answered some of your question partially. Again, it's early days in the evolution of this technology. There are some excellent mechanisms for trading, and there are lots of different use cases in the world, always are, for trading. Not everybody needs high frequency systems to trade in. Usually those are professional investors that are extracting value from retail investors. What we're seeing in our ecosystem are novel trading mechanisms. You mentioned automated market makers. These are systems that automatically will take either side of the trade, providing liquidity in roughly any situation. They are often subject to slippage, but it's great to have them there. And there are different kinds of pricing curves for automated market mechanisms. Some of the pricing curves make the slippage inconsequential for certain kinds of assets that those pricing curves are tuned for. You know, you hinted at bid and ask trading, essentially trading books, and one can imagine using automated market makers with a order book in the middle of that, so where the spreads get a little bit wide. Market makers can move in and narrow those spreads. We are going to see decentralized exchanges improve in speed and usability. Many of them are already rivaling the centralized exchanges in terms of volume at certain periods of time. We're going to see mechanisms built on top of these systems in layers to just enable better user experience. We at ConsenSys have a wallet called MetaMask, which is generally the wallet that all these DeFi protocols suggest that their users make use of. And we've recently rolled out something called MetaSwaps. So MetaSwaps is an example of one of those elements at higher layers that will make trading much more pleasant, much more efficient. We connect to many decentralized exchanges. We connect to aggregators of decentralized exchanges. We connect to other kinds of market makers. And we are now, and it just went live about 2.5 weeks ago, we are now able to scan the universe that we connect to for best possible price for a particular swap that you want to make, a swap from one token to another token. And it provides a one-stop uniform interface for a pretty large universe of the tokens. So the infrastructure is getting a little more sophisticated day by day, and ultimately these systems, as they get faster more usable, more private, more confidential, are going to be, they're going to eclipse centralized exchanges for virtually all classes of trading, just because they are going to be much more trustworthy.
Absolutely. So in terms of trust, how do you see that evolving from, the current systems where it's generally a small group of developers or initial founders of a platform that essentially have, entire control over X or Y system? It's really just DeFi theater in terms of, these major projects, say ETHLend or Yearn Finance or any of those, Curve. The power is essentially in the hands of 2 or 3 guys, and it's not too dissimilar to what a traditional kind of centralized platform would be, besides the part where you can trust that the code execution will always do what it says. But whether that actual code is changed, because many of the contracts nowadays have upgradability in terms of those Open Zeppelin templates, it's something to consider. I mean, how do you see that transition going from the team of initial developers to being community owned or truly decentralized?
Yeah, it's called Exit to Community, which was written about recently. I don't know how one starts a system as originally decentralized. It starts pretty much as an idea in at least one person's head, maybe a small number of people. So you're right about the origins of these systems. And we've had this notion of progressive decentralization in our ecosystem, where in order to get something like product market fit right, you need a relatively small focused group running the experiments on the protocol and making it work for the intended audience. So free market dynamics will determine which protocols win, which protocols are relevant. If you build a DeFi protocol, let's say for lending and borrowing, and you insist on keeping full control of it, you and your small team, that's going to be a less trustworthy system, and our community, which is very discerning, is not going to be attracted to using that system. So in order to gain real traction for your protocol, generally you have to be really explicit about governance. In many cases, you want to give governance away to the community. You want the people to own the system, to have stake in the system, and you need to use mechanism design to define different roles, which incentivize people to participate in your system and do so for their own selfish economic gain. If your system only supports your own selfish economic gain and providing a venue for people to trade, you're just not going to get the same amount of buy-in. So there have been protocols, low-level protocols in our ecosystem that raise lots of money, but really remained pretty centralized in terms of control. There have been other protocols like Ethereum and Bitcoin, which worked early and intensely to identify the different dimensions that could be decentralized and to spread participation and power across those dimensions as widely as possible. So that's the approach, that's the characteristic that I think is going to prevail in the end as many people scrutinize these systems and vote with their money to either use them or steer clear because they're not trustworthy.
Where do you see the regulators essentially taking this on? I mean, is there a point where decentralization would lead to some sort of whole entire new set of global regulations that would have to be adopted in some kind of FATCA type process? Or which kind of jurisdictions would these platforms that inevitably pop up with billions of dollars in value locked how and where will they be regulated?
So we've seen in the United States, for instance, regulators be initially a little bit slow on the take up, but more recently in the last couple, 3 years, really getting a deep understanding of the technology, the benefits and the potential pitfalls, especially as the technology is not fully mature. The SEC in the United States looked at a whole bunch of issuances of tokens, and they decided that some of them were acceptable, did not represent the issuance of and sale of securities to Americans, or unregistered securities to Americans. And they came up with this notion, sort of new kind of doctrine of sufficient decentralization. So they looked at the Bitcoin protocol, they looked at the Ethereum protocol, and they came to understand that those systems were pretty massively decentralized, even though they're fairly young protocols, and nobody was, quote, in charge. So no single small set of actors really controlled those systems. And so they deemed those tokens to be not securities, and therefore not subject to certain kinds of constraints and forcing them to be traded on certain kinds of venues. And since then, it's generally come to be acknowledged that that Bitcoin and Ether are more akin to commodities than to securities. So there are many elements. There are many elements of regulation that are designed to protect the consumer. If I have assets that I want to trade on a venue, I'm essentially required to hand those assets over and have them custodied by a third party. So in our ecosystem, you can actually retain full control of those assets until the instant of the trade. The trade happens in a trustless fashion, guaranteed atomic swap. And so I'm not really subject to custody risk in those situations. I don't have a crystal ball, so I don't know how regulation is going to evolve as we go forward, but regulators all over the world are getting savvy. They're running experiments, they're building proofs of concepts and pilot systems, and it's a brave new world, and especially in the DeFi space, where you have this tremendous innovation and tremendous speed of experimentation. And for the most part, the regulators that we speak with are excited about the potential transparency, the potential ability to watch value flows in real time, the potential ability to do real-time risk metrics and sensitivity analyses. So it's a big new infrastructure that's getting built bottom up, and it's just so promising that the technologists will essentially be working with the regulators to figure out what of this technology is appropriate for different societies. So one country may be comfortable with certain implementations or certain aspects of the technology, and other countries may not be. And so we'll see which society embraces which of these constructs.
I definitely think that there are massive advantages over traditional finance in dozens of different capacities, particularly in asset management. We're essentially getting rid of 5 different entities having different copies of the identical Excel spreadsheet and just changing a couple of figures in each one. Often, and embarrassingly enough, in traditional finance, that's done while striking a NAV via email or something like that, which is totally bizarre that we're still doing that in the 21st century. So it is extremely useful to have that sort of centralized or decentralized, in this case, ledger that everybody
logically centralized and implementationally decentralized.
Right, absolutely. So that is a wonderful innovation, and I definitely think it has the potential to pass a lot of cost benefits on to the end consumer at the end of the day, since you'll be able to get rid of dozens of middlemen. But those middlemen, I mean, the problem really is that those middlemen are kind of legislated into existence. The fact that they need to exist, transfer agents, etc., for no other reason than the law says they should, and that made sense 30 years ago, 40 years ago, before blockchain technology and the internet, when people had to keep these kind of books and everything had to match. How do you see that process changing going forward? Do you think that governments will be open to looking at this technology? I mean, just having something that is sort of immune to being edited, the immutability is amazing. I mean, particularly for regulators, they should really enjoy the idea of having blockchain technology. I mean, I feel like it should be mandated at some point.
Yeah, so it's a competitiveness issue. We have indeed had to build sort of useless appendages onto trading systems just because the law mandated that those elements of a system had to be in place. And again, they had to be in place either to protect the consumer or to ensure pricing transparency. I mean, there are lots of good reasons why the infrastructure of today evolved the way it has. So we'll continue to see the need to build efficient systems with the technology, with some potentially useless appendages for a while, for as long as the laws require those things. But there is already so much dialogue with regulators and lawmakers around the world on helping them understand the technology and taking a look at the rules and finding ways of rewriting rules or finding exceptions. So that's essentially happening right now. And this technology is going to be such an enormous advantage to societies that adopt it. Essentially, we're moving from a world of analog systems where our systems are built with pieces of paper and Excel spreadsheets and email, as you indicated. And so those are digital, but they're not natively digital. Those numbers represent issuance of currency that was essentially issued in a historically analog system. We have systems with rubber stamps and ink, all old analog technologies. And now we're issuing these digital assets, whether they're cryptocurrencies, stable coins, equities, debt instruments, and they're issued for the first time natively digital. They can trade atomically, meaning clearing and settlement happens in the instant of the transaction. There's no delays built into those systems. And so if you can imagine an economy where you've squeezed the delays out of the system, you've squeezed the frictions out of the system, you can still have regulation in there, but the regulation proceeds automatically. It's written into the programs that are embedded in essentially the digital assets. And so in that sort of context, you can build an economy that moves a lot faster, that has the ability to grow a lot faster. And nations around the world are understanding that and are figuring out how they can tool up to take advantage of this sort of digital asset revolution in trust, and the ability to run your economy a lot faster and foster growth.
Absolutely. So one thing I found truly fascinating has been this sort of Cambrian explosion in terms of development in DeFi, and just watching how the community itself has almost re-engineered all of traditional finance in the matter of a year or two, and rediscovered why certain things exist. For example, having the code audited, etc., before launching smart contracts. So that's been extremely interesting to see, and particularly how all the different classes of derivatives and options, etc., have built upon each other in this on decentralized fashion to kind of replicate that traditional market. So that's been extremely interesting, and I think we'll definitely get to moving a lot faster, as you indicated. So as we move into the future of this kind of DeFi space, and we move away from the centralized ownership to community ownership, do you think that'll ever be recognized legally, or would it be a sort of code becomes law kind of situation where people that have some kind of equity stake in this platform would have to declare it, for example?
Sure. So it's already happening. We have a project called Open Law that is building Delaware C corporations using purely blockchain mechanisms. So there's this notion of a Ricardian contract that references where you have a sort of real world analog world contract that references a smart contract on the blockchain. The smart contract is the mechanism that handles governance, and that smart contract points back to the sort of real world contract that's embedded in the laws of the jurisdiction. So that's happening already. Open Law has a bunch of investment vehicles that are doing remarkably well. So they've attracted a good amount of capital, and they've made maybe 20 investments, and because it's attracted some really savvy people, the portfolio's done remarkably well. So these systems around the world, that also in Wyoming, there are constructs for creating essentially decentralized organizations that have the support of the law. Again, it's going to be a dialogue between the builders, the creators, and the regulators, and it'll be about competitive advantage because, as I indicated in the previous answer, if you can enable constructs that are much less delay-filled and friction-filled, then your economy is simply going to run faster, and it's not going to start running faster right away, but the promise is pretty obvious, and many jurisdictions will race towards very significant implementation of the technology. There are, President Xi about a year ago, I think, indicated that China would put heavy emphasis on building infrastructure using blockchain technology. We'll see when they get comfortable issuing things like securities on blockchains. But it's happening everywhere. And I guess one other aspect of your question is an interesting one to consider. So just as the SEC in the US declared the Ether token and the Bitcoin token to be sufficiently decentralized so that it did not warrant constraints of regulation, one could imagine that a internet-based community, a collaboration network based on a blockchain with its own token, could be considered by regulators to be sufficiently decentralized. Maybe it spans many borders, and nobody can really contemplate how to regulate it. But if it's sufficiently decentralized, and if it's operating in a healthy way, then regulators might just say, it seems like it's going to be a wild goose chase, and I'm not going to devote a couple of years of my career to chasing something that I'm not going to be able to have a positive effect on. So these systems could end up taking on a life of their own, and if they start to do harm, then certainly regulators are going to pay attention and attempt to stop those things. But there are many systems in the world, many communities that don't operate under explicit regulation, and we'll see if some of these fit that pattern.
Yeah, that makes sense. It does seem like the community is attempting, some level of self-regulation in terms of, what they will decide to fund at the end of the day. I mean, the fact that these communities have users at all is testament to, the trust that they can build and the benefits that they can ultimately provide to the end user.
Exactly, and it's free market capitalism. If these systems are providing benefit to the user, then users will vote with their money and they'll participate. If they're not well constructed, they will die out.
Absolutely. And one thing that really excites me about, finance and decentralized finance in this capacity is that, it really reduces the geographical limitations of access to capital, whereas previously capital markets were very largely constricted to single geographies. And the best opportunities might not exist, for example, on the North American continent or Western Europe. And we've seen many of these DeFi projects come from traditionally areas where venture capital is very hard to reach. For example, Andre Cronier is a South African. He's developed UN Finance, many of the major billion-dollar DeFi projects as a single South African developer. And having access to capital like that is, I think, truly something revolutionary. Particularly many of the other projects being developed in Eastern Europe and Asia. So I think part of what makes a free market capitalistic system so powerful globally is allocating that capital efficiently, and I think DeFi goes some distance towards doing that, which leads to my next question of the specific subsectors inside finance, where do you see DeFi eating away at traditional finance soonest? So, for example, I mean, in terms of lending and asset management, those are two that are pretty strongly covered at the moment. I mean, where people are making significant gains. Platforms like Celsius and Exo, people are taking out loans against crypto, for example, whereas traditionally they would go to a bank. What else do you see being eroded by DeFi?
I think it's going to be everywhere. It's about building a new trust foundation for the planet. It's about building a new digital asset settlement layer. You're right that venture capital will be significantly affected, especially under COVID. With the advent of tokens and blockchain, it has become less and less necessary. If you're an entrepreneur, a technologist trying to get your startup funded and built, less and less necessary to move to San Francisco or the Bay Area, for instance. The context of these networks is naturally global, and you're right that the value flows fluidly across borders, and that's going to be really interesting, I think, as nation states increasingly have issues with one another, but have trouble trusting that those issues get sorted out in different international courts or in the UN, et cetera. And so having blockchain-based networks that that enable countries who don't trust one another to interact with one another. Maybe they put up security bonds behind a treaty or behind a major transaction. That's going to be a very interesting construct going forward. I guess as a general answer to your question, it's going to happen bottom up. We are building the protocols for borrowing, lending, full life cycle management of different tokens. The tokens can represent equities, bonds, and many other things. Derivatives are being built, synthetics are being built, where you're essentially representing some other asset with a token, insurance protocols, etc. So these systems are going to get much more granular. So there are things like insurance protocols that are really granular and parameterized that can be applied to very, very narrow aspects of financial ecosystem. There's going to be tremendous innovation there, and the technology's gonna. So it's basically like the innovation that you've seen on the Internet of Information, say since 1989 when the web protocols were invented. All of that innovation pretty much skipped the financial industry, where the financial industry did provide some interfaces via laptops and phones to people so that they could do the same old boring trading on different devices, but it didn't really change manufacturing of digital assets or different kinds of distribution. And that's all about to shift as all the financial architects, the creative people in the ecosystem are drawn to build out this much more democratized financial plumbing layer.
So in essence, I mean, we're building a much more global and liquid capital market. I think that's very positive, for humanity as a whole. What do you think about the death of cash and the introduction of central bank digital currencies? I mean, there's pros and cons either way. I mean, privacy concerns on one side, particularly in the age of COVID. I mean, it does make sense to accelerate that process. What are your thoughts on that?
It's possible that concerns about the death of cash are exaggerated. Again, it's a societal thing. If your jurisdiction wants to eradicate cash, say in the Scandinavian countries, then that's perfectly reasonable. Population votes for that, and the nature of your society warrants that sort of innovation, if we can call it an innovation. There will be other nations that have different philosophies and value different kinds of approaches to financial instruments. The technology supports cash. The technology supports private holding of financial instruments. It supports confidential transactions. And so it's really a discussion between the technologists that are building things that will be used in certain jurisdictions and the regulators that are representing what the society wants. Privacy technology is absolutely going to enable people to transact in cash fully anonymously, very fluidly and in real time.
Enjoyed that plug of Mark Twain. News of my death is greatly exaggerated.
Exactly.
So yeah, I just wanted to jump in with some of the questions from the Q&A from the audience, but before we hand it over to that, certainly would agree with Joe's points. Assuming the death of cash is probably a bit of an exaggeration, but we are seeing governments increasingly adopt effectively DeFi and crypto-based technologies. We referred to central bank digital currencies. Joe, you also referred to whether China might consider in the future digital securities as issuers, and we're aware of actually governments that are in the process of preparing to issue securities on semi-decentralized platforms. But do you see governments in their implementation ever being willing to go fully permissionless or sticking to permissioned protocols? Because that's certainly what we're seeing for the pipeline of projects that we're seeing coming out of governments and institutional organizations.
Yeah, so just to re-reference China, China has recently started issuing and enabling the usage of a central bank digital currency. It's a DCEP, digital currency electronic payment system. They've enabled it for a handful of use cases, gas stations, etc., in a handful of cities or regions. They actually used a mechanism out of the DeFi space or the blockchain space. They airdropped, I forget how much, tens of millions of dollars worth of digital yuan onto people so that they could take this new natively digital money and spend it in certain situations. So it's kind of a validation and exciting to see that, although it's not really a blockchain based system that they've used, but pretty cool. With respect to permissionless and central bank systems or nation state blockchain infrastructure, I think we will be surprised at how valuable permissionless is perceived by certainly the users, but also the regulators. And again, it's going to be driven by competition. So I don't imagine any nation state is going to come out with a decentralized system for central bank digital currency or a national payment system. They pretty much have to start pretty centralized. They have to start having control of the system, being able to shut down the system if things are going awry. And so like in our ecosystem, I think we'll see progressive decentralization where more and more freedoms and privacy and larger transactions involving confidentiality are enabled. We've had discussions with the major central banks around the world where they've asked the question, roughly the same question that you asked. How valuable, how necessary is permissionlessness in order to have this system maximally capable and adopted by, valued by the population? And some central bankers think that that sort of freedom, essentially these systems can represent truly free market economies. That's attractive. And it's not going to be attractive in certain nation states, but the nation states that value freedom in markets much more will be attracted to that. And they're not going to be competing only with one another. So there will be competition amongst nation states and central banks for the use of their systems, because the borders are getting less consequential in the context of this technology. But importantly, they're also competing with the systems that are out of the bag that we're not going to be able to put back into the bag. And these are the public permissionless systems. So the Federal Reserve coin, the Fed coin, will effectively be competing with Bitcoin and Ether on the Ethereum platform. And if you're building systems, and I do think these systems will be connected. So I do think that wallets will recognize both things like Federal Reserve coin and Ether and Bitcoin, for instance. So if people are building lending, borrowing systems and issuing different kinds of digital assets, we're going to want the state issued currencies on those systems, but we're also going to see those systems be real competition for the national infrastructure that is built by central banks and governments. So I anticipate much more permissionlessness over time than would be expected at this point in time.
Sure. So in terms of institutional investment in cryptocurrencies, Bitcoin's received the lion's share of attention. How far do you see institutions dipping their toes down, the coin market cap list. I mean, they've gone, through Ethereum, Ripple perhaps, but do you think there will come a time soonish when institutions will start to invest in, say, an altcoin index? Is that something that people are looking for?
So I don't know what people are looking for. And the list of different tokens on different protocols is populated by some good projects, and not all the projects at the top, in my opinion, are good projects. So call them popular projects and less popular projects. And there is just such an astonishing amount of innovation in the space that there will be some tokens that remain on that list and close to the top of that list, and many tokens that wash out of that list to be replaced by other projects that are essentially winning the competition to be used. And just as I indicated, with respect to financial infrastructure that needs to get built, it's going to get built in layers. So your thoughts around different indices, ways of packaging up tokens for certain kinds of more focused exposure or broader exposure, that's all going to happen. We're seeing portfolio management tools where you can essentially create a token that represents a set of tokens. That set of tokens can have a theme to it, and it can all trade automatically. So it can be a basket of tokens that's represented by a token that rebalances itself automatically at a certain point in time. And so mechanisms like that, mechanisms like bots that scour the universe for different kinds of tokenized financial instruments and securitize those and tranche those and offer those to investors. That can all happen in real time. It can all happen in seconds as things get increasingly sophisticated. So it is a brave new world that's getting built, and yeah, there will be many attracted to the space because it's going to be a multi-trillion-dollar space, and the tools will enable just really valuable activities and valuable exposure.
I think as final question from my side, in terms of the gas prices on Ethereum, essentially the transaction costs for those listening that might not be aware with the terminology. Essentially, what Ethereum has enabled us at Invictus to do is to, issue assets and funds essentially as a single token that might comprise of various assets, say gold, it could be cryptocurrencies or anything, and it's essentially reduced the admin burden to such a level, since everything's automated, that we can accept investors with really low investment minimums, say from countries that traditionally wouldn't have been able to invest in, say a Cayman hedge fund or a VC fund strategy or something like that. I think the last barrier to that ultimately is, transaction throughput, transaction costs, and getting those down. What are your thoughts on, how that'll play out in terms of the Ethereum ecosystem?
So transaction throughput, the number of transactions per second on the system, is increasing dramatically on Ethereum right now. So you can think of Ethereum as a two-layer system where layer one is the main network and layer two has a bunch of technologies that can handle much higher throughput in terms of transactions per second. Layer one can handle 20, 30 transactions, but layer two, in many cases, can handle tens of thousands of transactions. And so we're seeing the advent and the usage for decentralized exchanges or games of these layer two technologies, and they anchor into layer one sort of automatically, mechanistically, and they in many cases have the same sorts of security properties of transactions on layer one, but benefit from much greater throughput on layer two. We'll see that set of mechanisms in that space become increasingly sophisticated, increasingly high performance, and increasingly usable. We're doing a bunch of work at our company ConsenSys on that front. We've seen transaction fees in some cases skyrocket on the Ethereum network and the Bitcoin network, and this is happening because of supply and demand. It's happening because there's just so much activity for the state of the existing infrastructure, and that is a problem that humanity has had since the advent of the information technology industry. So for many decades, technologists, software developers have been maxing out systems, whether it's screen real estate or CPU or memory or battery. Developers are always bumping up. They're doing what they can do on these systems, and they're always bumping into the ceiling. And so what we need is more activity like that. We need to bump into the ceiling on Ethereum over and over so that we can identify exactly what we have to build where in order to essentially raise that transactional throughput ceiling. One scalability element that's coming live very, very soon, probably in December, is the start of the evolution of Ethereum 1.0 to Ethereum 2.0. And it's really going to be a smooth evolution in the sense that we're using Ethereum 1 to bootstrap Ethereum 2. Ethereum 2 will be released in phases. The first phase will have some sort of benefits for Ethereum 1. Very soon, Ethereum 1 will be absorbed into Ethereum 2. This layer 2 scalability mechanism that I discussed on layer 1 will benefit massively as we add more data shards to Ethereum 2. So essentially when Ethereum 2 is ready, which is probably 18 months from now, it will absorb Ethereum 1, and Ethereum 1 will continue to operate in a somewhat modified form in this larger, much more scalable context. So that's going to add some orders of magnitude to scalability.
Yeah, I think it's an excellent point, and I mean, it's a great proof of the technology, really, that the gas fees or the transaction fees are high in the first place means people are using the technology, which is it's a good indication of usage. If you look down, pretty eye-opening thing for me was to actually look at the fees paid per cryptocurrency network, and I won't name names, but there's a couple up there, in the top 20 that have embarrassingly low, total fees per network, and you can just see that, all of their claimed transactions and aren't quite not quite as what it seems.
So there are really only two of these blockchain systems that are getting much usage at this point: Bitcoin and Ethereum. Ethereum has recently eclipsed Bitcoin quite significantly, roughly doubling number of transactions and amount of value transacted per day. You're right. There are lots of other protocols, and some of them are starting to get a little bit of traction. It's great that there are other protocols because the decentralized or the increasingly decentralized World Wide Web will consist of many interoperating decentralized protocols, systems like Ethereum and Bitcoin, but protocols like IPFS and Filecoin for distributed storage, and protocols for bandwidth, and protocols for decentralized identity and proof of locations. Those smaller protocols are still an important part of exploring the solution space.
And that's a great way to cap off the discussion. I cannot thank you both enough. This has been incredibly insightful. We're actually already out of time. So I think most of the questions that were asked by the audience were actually covered off throughout the Daniel's Q&A. So I think this has certainly been an exciting discussion on the DeFi revolution and the building blocks within it. I certainly agree that we will be seeing increasing adoption and seeing that the market tends to vote with its feet. So that adoption is obviously being reflected in the price of the underlying instruments and the increasing number of transactions that we're seeing on these networks. Again, thank you so much to Invictus for sponsoring this webinar. Thank you so much, Daniel, for your adept moderation. And thank you very much to Joseph for being such a tremendous resource. We'd love to have you back. Certainly love to host you sometime in Dubai when traveling resumes to normal as well. We will be having another AIM Summit webinar next week on Wednesday, 11th of November at 4 p.m. GST. The session that's now popping up on your screen, Shifting Dynamics in Corporate Japan, will be joined by John Trammell, Managing Director of Global Strategic Initiatives at Symphony Financial Partners, Alicia Ogawa, Director of the Project on Japanese Corporate Governance and Stewardship at Columbia Business School, and our all-time favorite Chief Correspondent, Henny Sender from the Financial Times, joining us from Hong Kong. Thank you all so much for joining. If you're watching this on YouTube, please do like and subscribe to our YouTube channel, and certainly go to aimsummit.com to watch the sessions live and participate in Q&A. Thank you all so much for joining us.
Thanks, Joe. Thanks, Zach.